The stock market can really seem like a confusing place to a lot of people if you don't know much about it. But in reality, it's not that complicated to take a moment and understand what is actually going on and taking place inside of the stock market. Tons and tons of money is being made daily in the stock market, but tons and tons of money is also being lost daily. And in fact, the New York Stock Exchange trades over $169 billion each day, and this is only one of the many different stock exchanges from around the world. You can really look at the stock market as being similar to any other type of market, anywhere that goods are being bought and sold. However, unlike in a farmer's market where actual goods are being bought and sold, in the stock market, they are buying and selling something called securities. And what these securities are basically just financial assets. And financial assets can be anything from stocks, bonds, golds, silvers, to even real estate. When you buy a stock, you are actually in a way buying a small portion of a company. So, for example, if you're interested in buying Apple, and let's just say you want a few shares, one or two, you are actually in a way becoming a part owner. Now, it could be a very small part ownership, but you do have some rights that are given to you as a part owner. One of the most important questions around the stock market is what is actually taking place when you are buying and selling a stock? Well, one of the first things that happens when you are buying a stock is you set the price at what you may be willing to buy or sell it at. You then either use a broker or an online account that basically goes out and it finds somebody that is willing to buy the stocks at the same price you have asked for it to be either bought or sold at. Once this is found, the transaction is made, and normally there is a fee of around $10 to $20 nowadays for each transaction that is made. Millions of these types of transactions happen each day around the world, and this is really why stocks go up and down. So, for example, when you look at a stock chart of a certain stock, let's say Apple, and Apple has been trending down over the past couple weeks, this is because sellers who are trying to sell their stock will sell at a lower and lower price, or it can happen when a buyer will only buy a stock of Apple at a lower and lower price. This could happen for a number of reasons. It could be that the investor reports are looking negative, or there's bad news about the company, or sometimes even scandals around the company. People basically, when they get scared, they try and protect their losses by selling. And if they are selling at a lower and lower price, or noticing buyers are only going to buy at a lower and lower price, they may get scared and try to get rid of their stock. This is basically what happens when stock prices go down. When stock prices go up, it's basically when the opposite happens. When buyers are willing to buy stocks at a higher and higher price because they feel comfortable about the company or have even heard good news around what a company may be doing. And this is what drives the prices to go up. So that's basically a little rundown of how the stock market works, and you can pretty much think of it like any other type of market where goods are being bought and sold and the price is determined by the consumer. Where in the stock market, the price of the stocks is really determined by the investors themselves. It really can be that simple.